Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Jerome Hass is on the show today. He's portfolio manager at Lightwater Partners, and we'll be taking your questions on Canadian mid-cap stocks. Here's how you can reach us. You can call us 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. Jerome Hass joins us in studio today. It's good to have you join us. Thanks so much.
Thanks for having me.
It's been an interesting start to the year, I guess you could say. We saw a bit of turmoil on Friday after that Supreme Court decision. Maybe markets are still settling today. What are there sectors that you feel you're going to avoid in the meantime because of what we're seeing playing out in the U.S.?
Yeah, I think the Supreme Court decision on Friday really reiterates the fact that Trump is going to continue playing the tariff game. So even though he lost that round, he's going to come back with different versions of it. And so he'll either come in a sectoral basis or whatever else he comes up with. But as a result of that, I'd be very leery about any sectors that can be tariffed. And so the manufacturing sector is an obvious one for that. And, you know, we did have a great year in the stock market last year, but people forget what it felt like in February, March, and early April. It wasn't a great feeling in the Canadian market. And, you know,
like of last year, February, March, and early April.
So who's to say that doesn't come back?
Right.
And,
so those are some of the sectors you're kind of like wary of. Are there ones that you feel are maybe safer for people to be looking at right now? Obviously, the ones that are not affected by tariffs.
Well, oil and gas, to be honest, and particularly the oil side. And we're conscious of the fact that, again, President Trump wants to get the price of gasoline down because the re-elections are coming up in November, midterm elections. And so we think he'll do his darndest to get it down for those elections to improve the Republicans' chances. But aside from that, we still think the market is looking beyond that. And so we've seen a revaluation in the last few months of oil names, and we think that continues because they're just structurally undervalued and have been for a very long time.
You say, you know, when we're looking at the Canadian economy, I think that's what you're referring to. Inflation seems to be cooling, maybe a better chance of more rate cuts coming soon. How likely do you think that is?
We
That's to predict the future.
Yeah. Well, I mean, the latest numbers that come out have been certainly more positive. And so the chances have increased for that. Whether or not they do it this time or the next time is really for others to bet on. We're not that focused on the macro. So for us, it's less matter.
So you're more focused on mid caps, right? I mean.
No, we're in focus on mid cap stocks.
You're more focused on mid caps?
Yeah, we only do mid caps.
Yeah, that's what I said. Yeah, so you're more focused on mid caps. Are there any, I mean, obviously we'll get into it with your top picks and stuff, but is that kind of where you think investors should be focusing throughout 2026, maybe not looking as big?
Well, perhaps we're a little biased about this, but we think they should always be looking at mid-cap stocks because what's happened in Canada is there's been a real concentration of portfolios institutionally and amongst pensions that do have exposure to Canada, and it's in the very largest names in Canada. As a consequence, you know, the banks and others trade at very high valuations. And you look at some of the mid-cap names that have clearly been left behind by the market, who traded at much more attractive valuations. So, you know, the biggest knock that we have in the market is that valuations are high by any stretch of the imagination. So you can find ample examples of mid-cap stocks out there that don't face that. And so as a consequence, we think they're more attractive to look at.
Okay, and we'll get into that, of course. We're going to take a quick break right now, though, but we will be back with Jerome Hass of Lightwater Partners taking your questions on Canadian mid-cap stocks right after this break. Stay with us. Welcome back to Market Call. Jerome Hass is on the show today answering your questions. And we're going to start with a question from our inbox from Tom. And it reads, would you recommend Telus? Short and sweet. What do you think about this company just in general? Would you recommend it?
Well, I think I'm like a lot of Canadians, so I'm not a huge fan of the telecom stocks just because I don't like the oligopoly. And what was interesting was when I used to live in the UK, when I moved back from London, England to Canada, about the only three things that were more expensive here than in the UK were telecom prices, candies, and beer. And it's interesting that two of those three are oligopolies. So I think I have a bias against the telecom names. But you know, Telus is the second largest of the telecom plays in Canada. It's definitely an oligopoly. The share price of all the telecom stocks have traded down largely because of the lower immigration levels in Canada over the last year or so. They are highly dependent upon immigration for new growth in the business. And all four of the telecom companies are really dependent upon the wireless business. So Telus is about 7.5, 7.3 times EV to EBITDA, which is roughly in line with where its peers are at. It's kind of hard to get too excited about the business, to be honest, and so it's not one that we would look at, but there's worse places to hide your capital, and I think it's got a reasonable yield on it, so not our cup of tea, but it's a reasonable place.
8.9%, almost 9% yield. Okay, so maybe not your sector even really that you like to look at.
No, and there is also a risk too that gets cut, and I have read a couple of analyst reports saying that they're forecasting about a 30% dividend cut in that. So it's something for investors to be leery about in Telus.
For sure. Okay, we're going to go to the phone lines now. Jim in Peace River, Alberta is calling in with a question. Hi there, what's your question?
Good morning. I'm wondering about Baytex. Do you see the share price going much higher from here? They're finally up over $5. Where do you see them going over the next couple of years? Thank you very much. I'll hang up now.
Okay, thank you very much. I thought that question was on Propel Holdings, but I guess it's on Baytex Energy.
Yeah, so we actually met with management twice in January, and Baytex was in the doghouse because they made an acquisition in the States a couple of years ago that the market clearly did not like. And so I think they've since seen the errors of their ways, and they sold essentially all of their U.S. assets towards the tail end of last year. And so it's still a bit of a show me story, but I think they've been aggressive in the share buyback, which the market has responded positively to. It's still relatively cheap as a stock. And so, I think it's a great name. I think it's still a show me, and there's still issues about management given their U.S. acquisition.
All right, now we're going to go back to the phone lines. Chad in Saskatoon is calling in with a question. Hi, Chad.
Hi, Lindsay and Jerome. Jerome, my question is on Propel Holdings. It's growing revenue and earnings every year, yet the stock is down about 17% in the last 5 days. Do you see this as a pullback, as a buying opportunity, or is the market pricing in rising credit risk? I'll hang up and listen. Thank you very much.
Okay, thank you very much.
Yeah, Chad, unfortunately, I think it's the latter, is that there's been a real disconnect between the non-bank financials and the banks. The banks are trading at 52-week highs, and names like Propel or GoEasy are all trading down quite substantially, and there's concerns about the credit risk for that. So, I think the valuation is extremely compelling for Propel, as is GoEasy and a couple other names that you could probably come across in the non-bank financials. It just depends on how much of a hero do you want to be. Like, the market clearly is saying we're concerned about it. There's been a very profound sell-off in the last 6 months and names like that. And, I think you have to be leery about it. I think on a fundamental basis, I think they potentially could surprise the street given the bearish sentiment on stocks like this. But do you want to hold them going into the quarter is really a question. For retail investors, it's probably less of an issue than it is for institutions.
Okay, we're going to go to the inbox now. We've got an email from Sharon in Moncton, New Brunswick, and it reads, which of the spinoffs from Constellation Software would you buy if either Topicus Toy or Luminine LMN? Thanks. That's Sharon in Moncton. Do you have a preference in terms of any spinoffs from Constellation?
We have never owned Constellation,
okay.
And so we've never owned any of the spinoffs either. And the problem that all three of them are facing, including the parent company, is AI and the sentiment of AI towards software stocks. And so it's been a very, very difficult 12 months for the software stocks. Are we at a bottom in terms of valuation? Well, I keep thinking that, but the stocks keep going lower. And so it's really going to come down to sentiment in the stock. All three of them are much, much cheaper than they were a year ago. And, the parent company, I think, is trading at 10 times EV to EBITDA, which is ridiculously cheap for a quality stock like that. But does it go lower?
It's an interesting time for software stocks, right? Like, a lot of analysts are saying that people were, over aggressive in those concerns? What do you think? I mean,
I wholeheartedly agree. Like, we've been very long-term investors in Descartes, for example. In fact, we hold Descartes in lieu of Constellation, and we have for a very long period of time. If it wasn't for the fact that our cost base is so low and that we don't want to trigger a capital gain on it, we probably would have bailed on Descartes. But there's ways that we can hedge it with some of our hedge positions on the NASDAQ or on software names. But we find them all very attractive. The fundamentals are there. You still need software. AI is not going to replace that. And when we hit a bottom, as your guess is as good as mine.
Okay. We've got a caller now, Bernie, calling in from Toronto with a question. Hi, Bernie.
Hi, how are you? Good afternoon. I was thinking of taking a position in Nexus REIT. It's yielding about 8%. So I would like your opinion. Would you buy it or would you stay away from it? Okay, I'll hang up and listen for your answer.
Okay.
Thank you.
Thank you, Bernie. Nexus REIT. Do you look at that? I mean, a yield, is that kind of a reason for you to buy or stay away from something?
It can be positive or negative.
Yeah.
Sometimes if a yield is too high, it's a signal from the market that the yield isn't, or the dividend isn't sustainable, or distribution isn't sustainable. In the case of Nexus, it's quite Quebec's focused, Montreal in particular, and they've kind of had an evolution where they've tried to change the portfolio over the last 5 or so years more towards the industrial segment of the REITs, which I think is getting close to a pure play in that. And so we like the industrial REIT space. It's suffered with most REITs over the last 5 years. None of them have done particularly well. But I think Nexus is interesting. It's on the smaller side for the REITs out there, and so it doesn't get a lot of attention. But I haven't looked at Nexus closely in at least 3 or 4 years, but I think it's something interesting, and the industrials is our preferred subsector within the REITs.
Got it. Okay, we're going to take a quick break right now. We'll be back, though, with Jerome Hass of Lightwater Partners taking your questions on Canadian mid-cap stocks right after this. Stay with us. Welcome back to Market Call. Jerome Hass joining us today, and we're going to go straight to the phone lines. Chris in Delta, BC is calling in with a question. Hi, Chris.
Oh, good morning, Lindsay and Jerome. Thank you for taking the call. My question is on Rockpoint Gas Storage, RGSI, on the TSX. I've heard this name spoken about a few times over the last few months, and it seems to have a unique position as one of the only publicly traded companies involved in natural gas storage in Canada. And apparently their locations, if you will, their infrastructure is very strategically placed at opportune points down the process of transmission, development, et cetera, et cetera. And I think that they can take advantage of some of the price volatility, which can be extreme with natural gas. And I know that I believe this is a spinoff from Brookfield Infrastructure. So I'd just like to hear your thoughts on the name, if you think it's good for an investor with a long time horizon and who is also looking for an income name, and it does have a reasonable dividend yield.
Okay. Thanks for the question. Great question. So, yeah, Rockpoint, what do you think about this company?
We're very big fans of it.
You are.
Last time we were in Market Call, it was one of our top picks on it. It was shortly after the IPO. And, it just came out with results last week. We thought they were fantastic results. I think it really surprised the street that they were as resilient as they demonstrated with their numbers. And, this is an energy infrastructure play. And regardless of people's views on the potential success of the Carney government in actually getting a pipeline through or being more benevolent towards the energy sector, we need more energy infrastructure. And these guys are one of the providers of it. And generally, we haven't been very positive on the gas space in Canada because of echo pricing. It's, last September or in this fall, it was at negative 85 cents. Rockpoint is a beneficiary of that when they're literally being paid 85 cents to take natural gas. That's a pretty good business model in our view. So it has relatively stable earnings. I think they're evolving their business model. As gas becomes more prevalent, if we get more gas pipelines, they're going to be a beneficiary of it. It's very difficult to build these assets. The approval process is very long. Rockpoint is exploring some brownfields, which could provide some further growth, but they're really locked into key centers in California and in Alberta. So we just think it's a great long-term play. Analysts, I think the top target price in that is about $30. So we're not far off of this, but if you're looking for stable exposure to natural gas, and we are positive in the medium to long term in demand for natural gas, it's just we don't like the ways to play this. And to us, Rockport is one of the few plays that's palatable to us on Canadian natural gas.
Okay. Okay, we're going to move on to an email question. This one coming in from Nora, and it says, can you give me your thoughts on Savaria?
Yeah, Savaria is, for viewers that aren't familiar with it, they provide the equipment that's used for wheelchair access or lift access or other things along these lines. You sometimes see the Savaria on the back of a modified taxi or something. They're the guys that, one of the providers of it, big in Canada. They took their knock last year as a result of the tariff rumbling that we talked about earlier, but the stock has recovered quite nicely since then. It's about $1.5 billion market cap, trades at about 7.5 times EV to EBITDA. It's had one program which was called S1, which was essentially a program to focus on certain growth targets. They're now embarking on S2, the next generation of that. So it's a lot more focused in Europe, and I don't know if that's a result of President Trump, but they're certainly looking more to Europe than they are to the States these days. And there's quite positive growth on it. So we haven't met with the company for quite a few years now, but I think it's actually interesting, and it's one that we plan to do more due diligence on.
And so maybe that expansion further into Europe could protect the company against further tariffs is kind of what you're saying?
Well, it's a lot more benevolent and a lot more stable than what's going on south of the border. So it's, I think, natural for a lot of manufacturing companies to look to Europe for that reason.
For sure. Okay, we're going to go back to the phone lines now. Elliot is calling in from Hamilton, Ontario with a question. Hi there.
Good afternoon. MDA Space is trading rather choppy depending on positive or negative contract news. How would you see this as a long-term play, though? Thank you.
Thank you very much. Yeah, MDA Space has been going up and down quite a bit recently, but they do have some contracts with the federal government and whatnot. So long term, what do you think?
Well, we think it's a great play on the increase in defense spending in Canada. I think they recently spun off a new division. I think it's called North 49 or something along those lines.
49 North, yeah.
49 North, which would be specifically targeting the defense sector. And, you know, stocks that do have defense exposure are a rarity in Canada. So when there's positive momentum, as the announcements in the last few weeks have been, they tend to benefit from that. But as you can see from the chart there, it's been quite rocky. There's been some contract news over the last few years, or last few months about it. We do like the name. We don't have any exposure to it currently, but we've been doing our homework on it. And I think you want defense exposure. That's an obvious name to look at.
Okay. Back to the emails now. Peter has an email, and it reads, I was wondering what you think of IA Financial. I've held it for a long time and have done very well, but nobody ever talks about it. Okay, thanks for that. IA Financial, thoughts on that company?
Yeah, well, they took a very big knock last week.
Yeah.
They came out with Q4 numbers, and I think the stock was down about 11%. And as one analyst described it, it's a cautionary tale for the banks because its peers had relatively good Q4 earnings. And so although it was a mild miss for Q4, the reaction was rather severe by the market. And, to be honest, we've for long preferred Manulife over AI. And Sun Life just because of the valuation. I think Manulife has caught up a little bit in that. I haven't checked recently to see how AI or IA is relative to some of the others. But, I do think that investors need to think about the bank earnings that are coming up this week. And AI is a cautionary tale. Like if one of them comes up with a hiccup, you could see a double-digit fall in the share price because valuations are almost at 14 times for the banks. And when your valuations are that high, you expect perfection. And if you don't get perfection, you get a hiccup. You're going to get a reaction like IA had last week.
So for someone like Peter, who's had IA for a long time, says he's done pretty well, but just this recent hiccup, I mean, what do you do in a situation like that?
Just hold on, Peter. I mean, you've done well in the stock. It's a quality name. It's a great long-term holding. Stick with it.
Hold on for now. Okay, we're going to take another quick break. When we return, though, we will look at some of Jerome's past picks. That's coming up. Stay with us. Welcome back. Time now for Past Picks with Jerome Hass. So we're going to go back to these picks were on February 21st of 2025, so just about a year ago. Your first one is Main Street Equity. When you recommended it, it was at $200.78. Now it's at $108.25. So this one maybe didn't do as well as you expected. Are you still holding on to it?
We still don't know. It's still one of our largest holdings. And, I think the sentiment on a lot of REITs, especially those in apartments, has been impacted by the lower levels of immigration in Canada, and especially the lower student levels. And I think that it's pulled down Main Street as a consequence for that. But Main Street has not had a decrease in their rents, unlike the headline figures which you see for most of the apartments and the numbers that you see from StatsCan coming out. And the reason for that is that they're really focused on affordable rentals. And so the average in Canada, in Toronto, is $2,100 for an apartment here, the latest numbers, and their average is $1,250, and they're primarily focused in Western Canada. So it's that affordable segment there that really still has a lot of scarcity of demand. So as a consequence for that, they were able to raise their rates over the past year. Their numbers came out last week for their quarter. I think they raised them about 2.5%. The free funds from operation were up about 7% last year over year. So they're able to buck the trend that's been out there. And the other thing about Main Street is that they're now preparing to invest counter-cyclically. So they've got about $800 million in liquidity that they're going to go out and purchase rundown apartments. That's their mode of operation. They fix them up, put them back in the market, and all of a sudden something that was run down is now in the mid-market, as they call it. And we think it's ironic that the federal government's actually going into competition with them, because they, through Build Canada Homes, is essentially trying to build affordable housing. The problem with what they're trying to do, and these guys are in direct competition with Main Street, is that they're doing new builds. So if you do new build for affordable housing, it's going to cost you about $400,000 per apartment. Conversely, they're buying rundown apartments, and they pay on average about $125,000 per apartment. So they fix them up and they can put them on the market for $1,250. The federal government, assuming they're going to be as efficient as a private builder, which we've seen from recent pipeline successes, is maybe a stretch. But it's going to cost you about $3,000 a month to justify the expenditure. Yeah. So either the federal government's going to have to subsidize these, or I don't know how it's going to work, but I think they're better off just buying shares of Main Street.
And so you expect maybe long-term the shares of Main Street to go up? Because I'm just looking, just 2 weeks ago, Main Street was up the most it's been in 16 weeks. So obviously doing maybe a little bit better.
Yeah, no, it's been a phenomenal success story. So they've been listed, I think, for 26 years now. They've never raised any money in public, or any equity since the IPO, and they've grown at 18% a year. It's a great long-term success story. And now, because they're so loaded up with liquidity, they're going to counter-cyclically invest because they're getting bargains out there. They're going to grow the business much stronger organically than they have in the past.
Interesting. Okay, next past pick is DRI Healthcare Trust. So this one, total return so far, 40% total return, recommended at $12, now at $16. You like this one still?
Yeah, it's still one of our largest positions too. And essentially what they've done is they've taken a page from Franco-Nevada and their royalty model. Instead of applying it to gold, they're applying it to pharmaceuticals and drugs and biotech. And so as a consequence, it's kind of a conservative way to invest in the biotech space. It's got a good yield on it. It's a diversified portfolio. I think they've got about 28 royalties at last count. It's come back from some of the lower valuations that we've seen in the name, but we still think it's a great name. It trades at 6 times EV to EBITDA. It's got about a 3.5% yield on it, and it's about 6 times EV to EBITDA.
Nice. And lastly, Secure Waste Infrastructure Corporation. So recommended at just over $14. Now it's at almost $20. Total return so far of 40% once again.
Yeah, they still like this name. They came out with great Q4 results last week, which surprised the market on Friday. I think the stock was up almost 4% on Friday on the numbers. Again, it's an infrastructure play. They primarily do waste for industrial landfill and transfer processing. About a third of their business is energy, so wastewater, or a little bit of midstreaming as well within that. But in the past, it's been lumped in with the energy services names, and we think it should be valued more as a waste management company. So it currently trades about 8 times EV to EBITDA. Their sector peers in the waste management traded about 17 times. So we think it's at least worth 10 to 12 times EV to EBITDA. So there's still a lot more upside to the name from here, especially a name that's got about 80% recurring revenues. And so it's a stable business.
And also announcing last week a 5% dividend increase. So
yeah,
there you go.
Doesn't hurt either.
It doesn't hurt. Okay, we're going to be back in just a moment with Jerome Hass of Lightwater Partners taking your questions on Canadian mid-cap stocks. Stay with us. Welcome back to Market Call. Jerome Hass is joining us today to answer your questions, and we're going to go straight to the phone lines. Glenn in St. John's, Newfoundland, is calling in with a question. Hi, Glenn.
Hello. Yes, calling about Kraken Robotics, Canadian technology company. They seem to be on a worldwide subsea imaging and mapping. It's had a good run over the last year, and just wondering where you see it going from here.
Okay.
Thanks.
Thanks so much for the question. Yeah, Kraken Robotics, what do you think?
Well, I think Glenn's being modest. It's not only a Canadian technology company, it's a Newfoundland-based technology company. Yeah, we like Kraken. We hold it. Wish I owned more of it, but yeah, it's been a phenomenal play. Essentially, they make these batteries which are used by an American company which is focused on autonomous weapons. And so Kraken is the battery of choice in their underwater autonomous drones. And we believe that Canada should be looking at this seriously. Submarines are way too expensive for us, even for our expanded defense budget. It makes a lot more sense for Canada to be deploying this. Australia has been deploying it. They have a program which actually started, I think, in Q1 of this year. It's called the Great White Shark, and essentially it's these autonomous drones that are being built in conjunction with an American partner. Kraken is supplying the batteries for that, and so we think it's a very interesting play. We sometimes struggle with the valuation, but we've held the stock for so long that, again, we've got a pretty big capital gain on it. So we're reluctant to sell, and I think it's a great name. Canadians should be proud of this company, and it's one to hold in your portfolios.
One to hold, but is it one to buy right now? Like, I noticed you said you wish you bought more of it. Like, if you see the charts, it's just an upward trajectory. Is it kind of a little too high maybe for most people, or do you expect more of a run?
I do get emails from people. It's like it's hard to justify it, but at the same time, there's going to be explosive growth in drones because, firstly, from a human point of view, it's a lot easier to send an autonomous vehicle that doesn't have a human in it on a dangerous mission. Yeah. And so when you think about Canada with Arctic ice, it's probably a lot easier and safer to send a drone than it is to have a submarine if we had submarines that could operate at that, which is wishful thinking at this point. I do struggle with the valuation, but it's a great company, and I think more money is going to flow into that sector, and so I think it will catch up with its valuation through its growth.
Interesting. Okay, now we're back to the phone lines. Andy is calling in from Calgary with a question. Hi there. What's your question?
Hello. Hello to the both of you. And thank you for taking my call. Jerome, I wanted to know what your thoughts were on the company Constellation Software. I know the software, a lot of the software companies are not doing so well right now. They've corrected. But they've been very successful in the past. Would you be a buyer here going forwards? I'm just going to hang up and listen to what your thoughts were on Constellation Software. Thank you so much.
Okay, thanks, Andy. Yeah, we were talking about software earlier as well.
Yeah, well, and this one in particular, like
Yeah.
Constellation's been a phenomenal long-term growth story over the last 20 years. And unfortunately, their long-serving CEO retired in Q3 or Q4. And as a consequence, you can kind of see the stock trading off there. That was essentially as a result of him leaving. And so when there is a transition, people always say, well, there's bench strength, there's others that will there. I think it remains a show me story from that perspective. The other is that it's been also hit by the AI phenomena, and people say, well, do we really need software to the same extent that we used to? So when you look at where Constellation is right now at 10 times EV to EBITDA, that's less than half of probably a third of what it's historically traded at. And so I just think that if you're a long-term holder of this, I would stick with it. At 10 times EV to EBITDA, I think that at some point people will come to the realization that we will need software despite the power of AI. And so the worst places to put your money than Constellation.
Okay, now back to the phone lines. Gulam is calling in from Toronto with a question. Hi there, what's your question?
Hi, good afternoon. My question is on, I'm thinking of ARC Resources or Algonquin Power, whichever has more capital appreciation. But ARC Resources is my main selection at the moment. Can I have your views and see where the stocks are going? Thank you.
Thank you. Yeah, we'll start with ARC Resources. What do you think about this company?
So it's kind of in the doghouse right now, to be honest. They had bad Q4 results last week, and the Q3 results in November weren't great either. Essentially, they have one main project or asset, I think it's called the Archie, which has been a disappointment for them. It had disappointing Q3 results. Hitachi, sorry, yes, that's right. And the management removed the guidance last week from the Hitachi. So as a consequence, it's kind of a show me story. That being said, it is a quality assets. I think it's about 60-some% natural gas. So it's a little gassier than we prefer. We definitely prefer oil over natural gas in Canada. But it trades at about 5.5 times. And so it's a quality asset. I think it's got about a $14 billion market cap. If foreign money starts to come and look at Canada, which we think is a trend, I think ARC is one of the names that they would look at because it's big enough to be significant. It's a quality asset, and it's trading at a reasonable valuation. So I think ARC is a good place to have some money invested, and I definitely prefer it over Algonquin.
Interesting. Okay, we're going to take another quick break right now, but we'll be back with Jerome Hass of Lightwater Partners, taking your questions on Canadian mid-cap stocks right after this. Stay with us. Welcome back to Market Call. We're going to go right to the phone lines. Mike is calling in from Toronto with a question. Hi, Mike.
Hi, I'd like to ask about Cineplex. I bought a bit on the bounce back after COVID. Did really well for a while now. I know with the Warner Brothers issue and everything else, it's dropped. Do you think it's still a good hold here or a possible add?
Okay, thanks for that. What do you think?
Well, as a fellow shareholder of Cineplex, you have my sympathies, Mike, because we bought it in at COVID too. I think it traded as low as $7 in COVID, and we thought, wow, this would be a great rebound play. And 6 years later, we're still waiting to see that rebound. So they've had disappointing box office in Q3 and Q4 of last year. Q1 is better. They did have their biggest December, I think, since COVID. So the box office had some positivity there. But what was interesting was October was brutal for them and also for the cinema industry across North America, but it particularly hit Cineplex because of the Toronto Blue Jays. You remember the playoff run they had in October, and it really took a knock on the box office. They had
Interesting.
They had their worst box office since COVID. And so, you didn't think about it at the time, but, they're a leverage play, and so they're operating leverage. And so when box office comes down, it affects the earnings. So the Q3 earnings, which came out last week, were not too impressive, and the share price did trade down to it. But the real catalyst for this now is Ellis Jacob, who's their long-serving CEO, has announced his plans to retire at the end of this year. And so he has a strong incentive in his contract to sell the company before he leaves. And so if we work back 6 months to that date, say the end of June, that's how long it would take for the Competition Bureau to take a look at a potential takeover for the company. So we think there has to be an offer on the table before the end of June. So we're 4 months away from that. There's a couple obvious players out there. There's US listed Cinemark, a likely buyer. There's also the former company which made a bid for $34 for the company in 2019, which is Cineworld. It's currently held by the banks that took it over in bankruptcy because they basically forced them. Cineplex forced Cineworld into bankruptcy because they owed him $1 billion when they were negged in the deal.
Right.
And then there's also the Canadian pensions out there that this would be a great asset for them. So we think there's some obvious buyers out there. I know it's been a tough 6 years, but if you've held on this line, Mike, you probably worthwhile holding on a few more months.
Okay, good to know. Now we're going to go to our inbox. Terry has emailed us with a question, and it reads, hello, what is your view on Superior Plus in 6 to 12 months and longer? Superior Plus. So
this is a name that some people may remember this from cottage country. You see the yellow trucks driving around with Superior Plus on them that deliver propane. So people are a little less dependent on propane than they used to, but that's their bread and butter business. And so we went to their analyst day last April, and they talked about this new program called Superior Delivers. And it was supposed to be about how they're improving the logistics of their business and how it was going to have consequences positively in the earnings for last year. Well, they came out with the results last week, and they didn't deliver, to put it mildly. The share price dropped, I think, 18% on the Q4 numbers. And so we're kind of back to the drawing board where there's I think a management credibility issue in that they don't believe they're going to deliver. They pushed out most of the benefits being received by 2027. It's now 28. It's an interesting name, but it's a show me story right now.
A little risky. Okay, we're going to go back to the phone lines. Pooja is calling in from Oakville, Ontario with a question. Hi there, what's your question?
Hi, good afternoon. I hope both of you are doing well. Thank you again for taking my question. My question is on Rogers Sugar. I'm looking to invest in a dividend stock, especially getting away from the software and technology sectors. What do you think of RSI? If not, the other one that I'm looking at is CapREIT. Any thoughts on both of those would help.
Okay, thanks for your question. Okay, so Rogers Sugar, thoughts on this company to start?
It's an oligopoly again in Canada. So there's essentially, there was for a long time a duopoly with two players on it, Redpass and essentially Rogers. And then there was a new player that came into the market about 2 or 3 years ago, a disruptor. And so it threw things for a loop. It forced the incumbents to invest more in new capacity. And as a consequence from that, there has been capacities come on from Redpass, and I believe Rogers has also added some to it. But sometimes having 3 players in a market can be extremely disruptive. And so if you're looking for a very secure dividend, I would be cautious on the sector. Not a lot of people pay attention to the sugar market in Canada, but no. I think the disruptor could be detrimental to the industry.
Okay. Good to know. We're going to take another quick break right now, but when we return, we'll take a look at some of Jerome's new top picks. That's next. Stay with us. Join us tomorrow on Market Call. Ernest Wong will be on the show. He's head of research at Baskin Wealth Management, and he'll be taking your questions on North American large caps. And if you miss Market Call, you can always check out our podcast. You can find it on iHeartRadio and other platforms. And you can also watch full episodes on our YouTube channel. Okay, time now for top picks with Jerome Hass. So we'll just get right into it. Your first pick, Total Energy Services. What is it you like about this company?
Well, valuation, to be honest, it's super cheap. It trades at about 3 times EV to EBITDA and about 7 times PE. And I think the valuation in the energy service sector has just become so compelling that you've seen some money moving into it. So Total is about 650 million market cap, so it's a smaller of the sort of some of the names that are in the sector. So it's been a bit of a laggard, even though the price chart looks pretty good. It's actually underperformed what some of its larger peers are. So we see more money coming into the sector. We think eventually it trickles down to places like Total. But in the interim, you know, it's a great company run by Dan Halleck, who's a no-nonsense Saskatchewan lawyer. He's never had a write-down of any of the assets that he's purchased, which is a rarity in the sector. He's runs a very tight fiscal ship. He's got an excellent balance sheet, very, very strong. By the end of this fiscal year, we forecast that they will have zero net debt, which is impressive. It's going to be one of the fastest growing in its sector at about 16% this year, at the top end of the energy services. So we just think at 3 times EV to EBITDA with a decent dividend yield on it, this is a great name to own.
Interesting. Okay, next up is Surge Energy, exploring for oil and natural gas. Is that what this company does?
It's primarily an oil player.
Okay.
So it's about 88% oil. It does have a little bit of...
Which is what you like.
Which is what we like,
Yeah.
yeah. So we tie to the oil-heavy names are the ones we like.
Yeah.
So they're a producer primarily in southeast Saskatchewan and also in the Sparky in southern Alberta. We actually think it's one of these names, again, that's valued at a lower valuation than some of its larger peers, because as generalists are moving some money into the energy space, it's usually the very largest names that benefit from that. And there's not yet a trickle-down effect on this. You know, it's starting to use some water floods that have been very successful in the Clearwater area. And so it does help to reduce the decline rates. Surge has very low decline rates to begin with at about 25%. It's got about 12 years of drilling inventory, so it has long life assets. It's got a very decent yield on it. I think it's about 8% or so, or 7 around these levels. And we also think Paul Colburn that runs it is a pretty interesting guy, and you know, we think there's a pretty good name to hold.
Okay, last up, Fairfax Financial just reported Q4 earnings last week.
Yeah.
Yeah.
So Fairfax beat the street by a mile last week. I think they came in at $57 EPS, and the street was looking for 37, so it was quite a large beat. You know, this is a company that's run by Prem Watsa, who's often viewed as the Warren Buffett of Canada, and Fairfax can probably be best. The closest comp is probably Berkshire Hathaway, because they're both insurance companies that are heavily dependent on the investments. But the irony is, despite him being viewed as the Warren Buffett of Canada, it trades at a discount because of Prem, and that it's a lot more investment focused or oriented than some of its other peers. So when we look at Fairfax and we compare it to Intact, for example, which is about the same size, about the same return on equity, Intact trades at about 2.4 times price to book, whereas Fairfax is at 1.3. So it's almost half the valuation of its closest peer. And we think that's a pretty big discount. Even when you compare it to its much smaller peer, Definity. Definity trades at about 2 times price to book. So it's still a significant discount to its much, much smaller peer. So we just think, it's a name that gradually the valuation has come up. When we first bought it, it was at 0.7 times book. We're at 0.3 right now, which is reasonable. But anyways,
Okay.
it's good to know.
Okay. All right. That's all the time we have. Appreciate you coming in studio. It's good to have you join us.
Thanks for having me.
And thank you for watching Market Call. We will see you next time.